And now there will be keynote speaker. So I would like to welcome Alina Dragomir, Senior Policy Officer of Markets and Digital Innovation Department of European Securities and Markets Authority. Alina, welcome.
Thank you very much. So I hope I will manage to keep you awake after the lunch. Ladies and gentlemen, I'm very pleased and honored to be here with you today and to have been invited to address this distinguished audience from across the globe on behalf of ESMA, the European Securities and Markets Authority. I will cover some of the key topics for this conference, and I will highlight ESMA's role in these areas, and I hope this will give you a good overview of the EU regulatory framework and the key policy and supervisory convergence objectives in these areas. With these goals in mind, I will focus on the following topics: ESMA's role in the broader EU regulatory framework, CSDR, the regulation covering CSDs and security settlement in the EU, settlement discipline and settlement efficiency, sustainability, digital finance, and last but not least, cooperation. Before going into the main part of my remarks, let me briefly describe ESMA's role among the EU regulators and supervisors. ESMA was established in 2011, 2 years after a call from the European heads of state and government for more harmonized regulation and integrated European supervision. ESMA's establishment formed part of the wider European system of financial supervision. Like the sister organizations, the European Banking Authority and the European Insurance and Occupational Pensions Authority, ESMA's mission is to enhance investor protection, to promote orderly financial markets in the EU, and to safeguard financial stability. In addition, ESMA, the EBA, and the EIOPA work closely with the European Systemic Risk Board to achieve these objectives. ESMA's strategic priorities for the next 5 years are the following: fostering effective markets and financial stability, enhancing the protection of retail investors, strengthening the supervision of EU financial markets. These are underpinned by the following thematic drivers: in enabling sustainable finance, facilitating technological innovation, and effective use of data. As you have already seen, these are all common themes for that kind of, let's say, form the biggest part of our conversations in today's world. As an independent institution, ESMA achieves this mission by building a single rulebook for EU financial markets. This involves, for example, delivering technical standards and technical advice to the European Commission. To ensure consistent implementation and application of that single rulebook across the EU, ESMA actively coordinates national supervisory activities and drives for convergent supervision and enforcement. To support this process, ESMA develops supervisory convergence measures such as guidelines and recommendations. ESMA does not develop technical standards or technical advice or supervisory convergence measures in a vacuum. Our text must, quite rightly, reflect input not only from the national competent authorities, but also from the wider stakeholder community, such as yourselves. We also have close working relationship with the European Commission, the European Parliament, and the Council of Member States, and ESMA is formally accountable to the Parliament and the Council. Another important activity of ESMA is assessing risk to investors, capital markets, and financial stability. Last but not least, ESMA is mandated to supervise some key types of financial services firms with a pan-European reach, such as credit rating agencies, trade repositories, CCPs, securitization repositories, and data reporting service providers. My next topic is focused on the EU regulation underpinning the services of CSDs and security settlement in the EU. This is CSDR, which entered into force in September 2014, so quite a while back. The CSDR regulation represents a fundamental milestone in the process of harmonizing post-trade activities in Europe. Some of the main objectives of CSDR are enhancing the safety, efficiency, and consistency of security settlement in Europe, with a particular focus on cross-border transactions, recognizing the systemic importance of CSDs and introducing single rules, prudential and conduct of business requirements to increase the resilience and standards for the European CSDs, strict access rights to CSD services, increased prudential and supervisory requirements for CSDs and other institutions providing banking services ancillary to security settlement, harmonizing certain aspects of the settlement cycle and settlement discipline, and last but not least, an obligation regarding the dematerialization for most securities. The CSDR Level 1 requirements are further specified through Level 2 or Level 3 measures, so these form part of the three-step legislative process in the EU. And ESMA, as I have mentioned, is responsible for Level 2 and Level 3 measures. Since the entry into force of CSDR, all European CSDs have been authorized under CSDR. And currently there are 27 CSDs authorized, out of which 4 have a banking license. CSDR also foresees a separate process for the authorization of banking services, or CSDs providing banking services. In addition, there are 6 CSDs that are managed by central banks, which are not subject to authorization under CSDR, but they are subject to the prudential requirements and conduct of business requirements. I would like now to refer to an important objective of CSDR, which is the freedom of service. So any CSD which is authorized in the EU may provide CSDR services throughout the EU, including by setting up a branch, provided that those services are covered by their authorization under CSDR. This is an important element which facilitates cross-border services, and it should be mentioned that we have already seen the first case of CSD with branches in 3 other states. And this is the Latvian CSD, Nasdaq CSD. We have heard about their experience with the consolidation process from their representative in one of the panels yesterday. Another example of cross-border provision of services is the interoperable link between the 2 ICSDs, Euroclear Bank and Clearstream Bank in Luxembourg, that is used to settle transactions in international securities such as Eurobonds. Last but definitely not least, I would like to highlight the key role of the Eurosystem platform, Target 2 Securities, which provides settlement in central bank money and which lays the foundations for a single market for security settlement and thus contributes to achieving greater integration of Europe's financial market. Currently, 19 CSDs use T2S, with several others preparing to join in the near future. When it comes to third country CSDs, they may provide services in the EU, including through setting up a branch. And currently, settlement services do not require recognition. However, for notary and central maintenance services in relation to financial instruments that are constituted under the law of an EU state, require ESMA recognition following an equivalence decision published by the European Commission in respect of the third country jurisdiction. It is worth mentioning that the ongoing review of CSDR, so the main legislation for CSDs in the EU, envisages a simplification of the passporting process for the European CSDs, and some changes are also expected regarding the third country CSD regime, such as the requirement for third country CSDs to notify ESMA regarding the services they provide in the EU. We will need to wait and see for the outcome of the negotiations on the CSDR review, which are expected in the coming months. The next topic I would like to address is a recurrent theme for current policy and supervisory discussions, and is also a major theme of this conference. And I'm, of course, referring to settlement efficiency. The EU settlement discipline regime covers measures to prevent settlement fails as well as measures to address settlement fails. CSDR foresees 3 types of requirements on preventing settlement fails, and these are addressed to trading venues, such as the procedures that enable the confirmation of relevant details of transactions in financial instruments on the date when the transaction has been executed. They are addressed to investment firms, such as the measures to limit the number, of settlement fails by confirming and allocating securities and cash related to transactions on maximum T+1, and of course measures addressed to CSDs, which cover several CSD functionalities, such as a requirement on automation, matching, bilateral cancellation, hold and release, partial settlement, recycling, RTGS, or if that's not available, at least providing settlement in 3 batches per business day. In addition, CSDR foresees 4 main types of measures for addressing settlement fails, so once settlement fails have occurred. And these are the monitoring of settlement fails and reporting of settlement fails, a requirement which has entered into force in February last year. A cash penalty regime applied to CSD participants that failed to settle transactions. This requirement also entered into force in February last year. The suspension of consistently and systematically failing participants, and this is, of course, last resort measure, and a mandatory buying process, which is currently suspended until November 2025, and is also subject to review as part of the ongoing CSDR revision. ESMA, together with the NCAs, the national competent authorities, is closely monitoring settlement fails. Next year, we intend to publish a report on settlement efficiency in the EU, including the impact of cash penalties and a comparison between CSD settlement and settlement conducted, internalized at the level of custodians. In preparation for this report, ESMA is in contact with trade associations, with EXDA being a main interlocutor, given the relevance of this topic for CSDs. We believe that an important part of the work to improve settlement efficiency is to identify the root causes of settlement fails and to tackle those that may benefit from changes, be it at the level of participant behaviors or rendering market practices or systems more efficient. For this, CSDs need to liaise with their participants that in turn need to conduct an assessment of their own. We acknowledge that this is a complex process which will take time and for which communication and cooperation are key success factors. A topic which may impact settlement efficiency is a reduced settlement cycle. So, talking here, of course, about the famous potential move to T+1. According to the ongoing negotiations on the CSDR review, ESMA may get a mandate to elaborate a report. The exact timing is still to be confirmed, potentially covering an overview of international developments on settlement cycles and their impact on capital markets in the Union, as well as an assessment of the cost and benefits of shortening the settlement cycle in the Union. It's also one additional element for consideration could be, for instance, adopting a different approach by type of financial instruments. And so basically having tailored settlement cycles depending on the type of financial instruments. ESMA has started first discussions with NCAs and with the industry on this topic, which have highlighted the importance to continue monitoring international developments on T+1 and investigating the potential of shortening the security settlement cycle in the EU, while noting that settlement efficiency remains the priority in the EU for now. So I'm also looking forward to the discussions on these topics during the upcoming panel on settlement efficiency later today. The next topic I would like to tackle is linked to sustainability. We have come a long way in the process of developing the regulatory foundations for ESG in the EU, but further work needs to be done as the EU sustainability agenda unfolds into further concrete steps. This will require tackling significant challenges. Tackling greenwashing and achieving transparency is key to ensure that capital does reach projects that target the mitigation of environmental or social or even governance issues. Regulatory cooperation will facilitate this process, as will the continued exchanges between the official sector and the industry. At ESMA, we trust that together we can seize the opportunities to accelerate the transition to a more resource-efficient and sustainable economy, and further develop the regulatory framework that is needed to allow for enhanced capital flow, also to social investment objectives. Let us first take a step back and remind ourselves when this journey to adapt our financial regulation to the transition started in the EU. The main pillar was the action plan to finance sustainable growth that the European Commission launched in March 2018. It contained an ambitious package of legislative measures to drive how the financial sector could support the transition to a more sustainable economy. Key legislative actions stemming from that plan were the taxonomy regulation, the sustainable finance disclosure regulation, and the revisions to the benchmarks regulation. In addition, requirements around the distribution of investment products were amended through MiFID II, the level 2 measures, and other initiatives were launched, such as the EU Green Bond Standard. ESMA has actively contributed to these legislative developments since the action plan was published, such as, for instance, through the technical advice to the European Commission on the disclosures supporting the EU taxonomy. Since 2018, other flagship initiatives have followed, such as the European Green Deal, the Commission's renewed strategy on sustainable finance, or the Fit for 55 package. ESMA has developed its own sustainable finance roadmap, which sets out 3 priorities: promoting transparency and tackling greenwashing, capacity building, increasing the knowledge and expertise of ESMA staff and the national competent authorities, monitoring and assessing ESG markets and risks. As it has been mentioned during the discussions on this topic yesterday, CSDs, as trusted financial market infrastructures, can play a key role in supporting these objectives as ESG taxonomy promoters and gatekeepers. Moving on to the next topic, a topic that is a highlight of this conference, the digital finance. We can imagine technology pushing back the boundaries of what is possible, enabling financial entities and investors to explore new ways of interacting and doing business. Historically, exploring new frontiers could be an exciting and fruitful task, but also a risky one. New territory can contain hidden dangers. One overarching risk and an inescapable feature of the digital age is cyber risk. At the cutting edge of technology and innovation, authorities need to promote a secure and resilient environment as far as possible. Across the wider economy, data generation, use, and storage have grown exponentially for decades. Firms across the financial sector are increasingly linked as they transact and communicate electronically. Technologies such as APIs enable data to be readily accessed across systems, including by third parties that provide analytics and compliance tools. The profile of firms providing financial services has evolved significantly in the last decade or so, powered by online technology. Fintech firms have entered the marketplace, often providing niche services. We have also seen large technology companies, big techs, providing certain financial services. And on top of that, financial entities increasingly rely on technology companies to provide their ICT services via the cloud. Taken together, these trends amount to a more complex financial services value chain and greater operational interdependency among firms. One technology with a diverse range of use cases is distributed ledger, or DLT. Applied to financial instruments, it can make settlement cycles quicker, more efficient, and more transparent, as it requires fewer intermediaries and enables greater automation. With these benefits in mind, the DLT pilot regime has started applying in the EU as of 23rd of March this year. Tokenization, or digital representation of financial instruments on DLT, or the issuance of traditional asset classes in tokenized form, to enable crypto assets to be used, stored and transferred on DLT, is expected to open up opportunities for efficiency improvements in trading and post-trading processes. However, as it has also been highlighted during the previous panels today, these also bring with them some additional risks that would have to be carefully assessed, both by supervisors as well as by the financial companies themselves. The DLT pilot, which is supposed to run for a period of 3 years initially, with the possibility to be extended for another 3 years by the European Commission, based on a report to be prepared by ESMA, facilitates the setup of new types of FMIs, the DLT FMIs. So we can have authorized investment firms and market operators that may apply to operate a DLT multilateral trading facility. Also, authorized CSDs may apply to operate a DLT security settlement system. Both groups may apply to operate a combined DLT trading and settlement system, which is also a novel hybrid type of infrastructure. At the same time, new entrants may apply for temporary authorizations as investment firms or CSDs, and also take part in the DLT pilot regime. Under the DLT pilot, the national competent authorities will authorize and supervise the firms, while ESMA will have an important coordination and convergence role. For example, ESMA has already issued and will continue to issue guidance on several aspects of the DLT pilot, and will also issue opinions on the national authorizations. We are glad to see that the first 2 official applications have already been submitted, and more than a dozen potential applications are in the pipeline for the second half of this year and next year as well. The DLT pilot regime provides the legal framework for trading, for the trading and settlement of transactions in crypto assets that qualify as financial instruments under MiFID. MiCA, another piece of EU legislation that forms part of the digital finance package introduced by the European Commission in 2020 to further enable and support the potential of digital finance, covers other crypto assets that do not qualify as financial instruments, such as, for instance, stable coins, e-money tokens, or utility tokens. MiCA is also an important milestone. Crypto asset service providers will, for the first time, be subject to authorization and supervision by NCAs. In addition, MiCA will give ESMA a new product intervention powers. MiCA includes a substantial number of draft technical standards and guidelines that will have to be developed before the entry into application of the new regime. Responsibilities for developing these measures are split between ESMA and the EBA. The work will be allocated into 3 packages, with the first consultation expected to be launched before the summer, the second one in autumn, and the third one next year. Let me now turn to one overarching risk that we all face, and one that is inextricably linked to digitalization, namely cyber risk. Cyber risk is in part driven by the structural developments I mentioned earlier around online provision of financial services, reliance on vast data sets, and growing operational interconnectedness across and beyond the financial sector. At the same time, momentous and tragic events such as the pandemic and Russia's war of aggression in Ukraine heighten the risk level. Managing cyber risk effectively and building digital operational resilience is vital, not just for the individual firms and authorities, but for the entire financial system. The Digital Operational Resilience Act, or DORA, is now in force in the EU. It is designed to address the fundamental threat of cyber attacks and ICT disruptions in the EU financial sector. DORA also recognizes the reliance of financial firms on third-party ICT service providers. Where third parties provide critical services, DORA mandates the European supervisory authorities to oversee their activities. DORA will apply across the entire EU financial sector. An important part of this work will be to draft the technical standards, bringing the technical precision needed for the new rules to operate as effectively as possible. We recognize the importance of gathering the views of the industry stakeholders and as an integral part of this process. We will seek feedback via public consultations in the coming months and year. A still greater challenge will be to implement DORA once it enters into application to make the EU financial sector more secure and resilient. DORA introduces a formal requirement for ESMA and the other European supervisory authorities to cooperate with our counterparts internationally to monitor and assess cyber risks. This will help us to further enhance our knowledge and expertise. Of course, achieving DORA's objectives will crucially depend on the endeavors of individual firms across the financial sector. We will support the industry as much as possible in this vital effort. To sum up, when we survey the frontier of innovation in capital markets, we see a complex and fast-moving situation. Digital technology continues to reshape the financial sector, creating new interfaces and new connections between financial entities, consumers, and third-party providers. Digitalization brings many benefits, but also many risks, one of which is the growing risk of cybersecurity threats to the financial sector. ESMA is working closely and intensively with the other authorities and in order to promote digital operational resilience across the EU financial system, but also at international level. Last but not least, I would like to conclude my remarks by focusing on cooperation. At this juncture, a time of major change for financial markets, a time marked by heightened economic uncertainty and elevated risks, a time of transformation with an increasing use of new technologies and data, significant reforms are being discussed in different parts of the world which could have a material impact on capital markets. In the face of these macroeconomic uncertainties, regulators are making efforts to promote fair and effective markets and ensure investor protection. In many areas, regulators' objectives across the globe are quite aligned. As we have experienced in the past years, our economies are strongly integrated at global level. In this context, extensive interactions between regulators, both formal and informal, close cooperation on risk assessment and priority setting, as well as coordination on specific policy actions, is paramount to ensure effective regulation both at regional and international level. At ESMA, we strongly believe in international cooperation. We have regular discussions with our fellow regulators and actively contribute to the important work led by IOSCO or the FSB. ESMA will continue to promote the spirit of cooperation and communication with other regulators, with market participants and financial market infrastructure, such as CSDs, that play a crucial role for financial stability and the orderly functioning of capital markets. Thank you for your attention. I'm happy to take any questions if we have time. If not, I see that no. Then if not, let me wish you a productive rest of the conference. Thank you.